This is our first lesson on theory of the firm after having made the paper chain in our production runs the previous class. We're going to look at the main objective of firms, and in essence the main objective is to maximize profits. Although this may not be the only objective. We looked in the last production run of the paper chains, we looked at total, marginal, and average product curves. So we're going to look in this case at a hypothetical firm that uses only two inputs, land and labor, where land is the fixed input and labor is the variable input. We can think of this as the simple farm. The only way the farm can increase the quantity of its output in the short run, I'd like to emphasize, is by increasing the quantity of labor it uses. It cannot increase the quantity of land because land is considered the fixed input, and in the short run, fixed inputs cannot be changed. We looked also with the paper chain activity, we looked at total product, marginal product, and average product. And they're listed here for your reference because you may well have to calculate these quantities and ratios in a paper 3 quantitative question. Total product, of course, being the total quantity produced, in the case of the paper chains, the links. The marginal product is the additional or extra or additional output when we have one additional input of variable labor, variable input being labor. And in the case of the paper chain, we were adding one labor at a time, so going from 1 to 2 labors, how much more product did that result in? Going from 2 to 3, how much more product did that result in? However, we don't always do these nice jumps from 1 to 2 to 3 workers. If it's not going up by simply 1 unit of variable input, we have to then divide by the change in the units of the variable input, or in the case of the paper chains, of labor. The average product is nothing more than looking at the total product divided by the units of the variable product, or in our example, labor. We looked at what was happening as we added more and more workers to the scenario of the paper chains. And at first, when we had 1 or 2, 3 or 4 workers, we were quite productive. So you can see that the curve is really relatively quite steep. As we added more and more workers, we saw that it became less and less efficient, so the curve starts to flatten out because we're getting less of a gain for each additional worker. Some of the groups also experienced, getting towards 8 workers, the phenomenon that at the very top, the output actually started to decrease, and this can happen as well. So what might happen as you continue to add more workers? Certainly the productivity diminishes, and in fact the total product may actually start to decline. And the slope was what I was talking about at the beginning, where you have increased efficiencies as we add 1, 2, or 3, 4 workers, but then starts to become much more or less efficient as we add more, so the slope flattens out. With the average and marginal product curves, if we were to graph these, we can see that at the beginning both of them increase, and that's when we are becoming more and more efficient, adding a few workers at a time. But then we got to a point of optimization and started to see declining gains as we added more workers. The law of diminishing returns is an absolutely key concept that you need to know really quite well. According to this law, as more and more units of a variable input, such as labor or workers, are added to one or more fixed inputs, such as land, the marginal product of the variable input at first increases, and then there comes a point where it begins to decrease. So in other words, it becomes less and less efficient as you are adding more of the variable input, and in our case it was workers. If you think about the example on the farm, it happens because of overcrowding. Each additional worker has less and less land to work with, and so produces less and less output. In a factory, each worker will have fewer and fewer machines to work with, and so will add less and less output. And we saw that with the frustration of making the paper chains, where people wanted more staplers, more scissors, and more factory floor, but being in the short run, those factors were fixed, and so as we added more and more workers, it became less and less efficient, and not everyone had machines to work with. So imagine if we go back to the farm example, if the law of diminishing returns did not exist, we know that there's not enough food in the world to feed everyone, or at least not everyone has access to enough food. And if there wasn't any diminishing returns, you could imagine there being farms sprinkled around the world where all we had to do was simply add more and more workers to a fixed amount of land, and we would keep producing more and more and more. We know that not to be the case, and this is a clear impossibility. We're going to look now at the concept of economic costs, implicit costs, explicit costs, and we're going to compare and contrast that to accounting costs. We know that when firm uses resources to produce, that they incur costs of production. These are money payments in essence for sell, for the use of resources, sell being land, labor, capital, and entrepreneurship. Because of scarcity of the best alternative use of that resources, we know that there's an opportunity cost. So we can say in essence that all production costs are opportunity costs and are known as economic costs. So looking at economic costs, we can distinguish two kinds of economic costs and two kinds of opportunity costs. And the key thing here is it depends on who owns the resources used by the firm. Resources are either owned by the firm itself or are owned by outsiders to the firm, and then the firm, of course, has to buy these resources from an outsider. So explicit costs. What I'd like to think about for explicit costs is think that the firm in this case does not own the resources that it's using. So in other words, for those resources in plain English, they're going to have to pay out of pocket. So you are physically taking money and handing it to another party. So it buys these resources from outsiders and of course makes payments to the resource supplier. So examples could be hiring labor and paying a wage, purchasing material and paying money to the seller, or using electricity and paying the electricity supplier, and so on. All of these are explicit costs. Implicit costs are a little more complicated. This time the firm might own some of the resources that it uses for production. For example, an office building. In this case, you're not paying yourself for the use of the office space. But think, if instead of using the office space yourself, the firm, you could have rented it out to another party for, let's say, $4,000 a month, there's an opportunity cost there because you're giving up or foregoing that rental income that could have been earned if the building was rented out. So that's an implicit cost. There isn't actually a money transaction, but it is the opportunity cost that you could have had, or excuse me, the opportunity cost of not renting out the building. So economic costs is nothing more than adding together the explicit and implicit costs. A firm's accounting costs is different. We'll mention this briefly, but this is not part of what we're going to take into account as economists. The firm's accounting cost does not take into account the implicit costs, and we'll see an example coming up to make it a little clearer. But in terms of accounting, in essence, they're looking at the money flows. So what actually did you have to pay for out of pocket, and that makes up the firm's accounting cost. So an example, let's try to decide whether these are implicit or explicit. So we're going to start off with you had a job with a salary of $60,000 a year, but you decided to quit to open your own business. Now, is that implicit or explicit? Did $60,000 actually was $60,000 actually made as a transaction? The answer is no. It's the money that you've given up by starting your own business. So this must be implicit. You estimate that your entrepreneurial talent that you're putting into the business is worth $45,000 a year. Again, is that $45,000 a year actually being paid out? Is it actually a transaction that's being paid? The answer is no. So again, this is an implicit cost. You set up an office in a spare room of your house that you used to rent out for $4,000 a year. Again, is money actually being given from one party to the other? The answer is no. So this as well is an implicit cost. Here, furthermore, you borrow $30,000 and you're going to use that to buy supplies and material. On top of that, you have to pay the bank $2,000 a year in interest for the use of those funds. So if we look at the $30,000 that's been borrowed to buy supplies and materials, that would be an explicit cost. You're actually paying the supplier. In terms of the $2,000 a year for the bank interest, you're actually paying that to the bank, and that's part of your explicit cost. You have to pay that out of pocket. And lastly, you hire an assistant who you pay $18,000 a year. Again, paid out of pocket, an explicit cost. So here we have the breakdown. We have the implicit costs, which we had identified on the previous slide, the explicit costs that we had to pay out of pocket, and so we look at the economic costs altogether, being $159,000. If we were looking at accounting and doing financial statements for shareholders or for the bank or for Revenue Canada, we would only be claiming $50,000 in expenses and not the additional $109,000 in implicit costs. But in economics, we include the implicit costs. Try to remember this example when we go to look at the different types of competition and we start looking at the revenue and cost curves, because the cost curves for theory of the firm, as we look at it from the standpoint of being an economist, will include these implicit costs or these opportunity costs. Fixed costs are costs that do not change as production is increased or decreased. So in other words, you have to pay for these things even if you produce absolutely no units. So examples of fixed costs could be things like rent, insurance, executive salaries, etc. And fixed costs, if we were going to graph them, would look like just a straight line. Variable costs are costs that vary in direct proportion to output. So in other words, as you produce more, your variable costs will go up. So to produce more output, in this case the firm hires more workers and the wage costs increase. If output were zero, then what would variable costs be? Variable costs would also equal zero. So examples of variable costs could be hourly workers, raw materials, packaging, etc. And graphically, it looks like we would start at the origin and it would increase. This does not have to be a 45-degree line by any means. It depends on the particular cost structure. Total costs we saw when we did the paper chain activity and did some very elementary graphing. We know that total costs are the sum of fixed and variable costs, and we know that that cost curve will lie above the variable and fixed costs because it's nothing more than the height of the two curves being added together. Short-run average cost curve. In the short run, at least one factor is fixed. For example, you cannot quickly change the size of buildings, factories, heavy machinery, etc. Think of the example of making the paper chains with a limited shop floor space and limited capital, the 2 staplers and 2 pairs of scissors and 2 desks. Why does an average cost curve increase after a certain point? Well, we know that when we added the first, second, third, fourth worker, they were very, very efficient. But after we kept adding more workers to the fixed amount of capital, so we couldn't change the shop floor and the 2 staplers and 2 pairs of scissors, we couldn't get more, we couldn't give away any, they were fixed. We found that we had greater inefficiencies as we added more and more workers, and it certainly became problematic when we added the 8th worker. There was tremendous overcrowding and great inefficiencies. So costs at a certain point will start to increase. The actual position of the average cost curve will vary with a number of factors. So if we look at factor inputs, labor, materials, and so on, the cheaper the inputs, we're going to find that we have the lower the average cost will be at any given output. Now, productivity. Please make sure that you're very familiar with this definition. It can be defined as output per unit of input. The more productive the firm, the more output it gets from its inputs, and once again, the lower the average cost at any output. These look like an awful lot of graphs all thrown together, but we'll take a look at them one at a time. This is basically where we're heading, looking at the cost curves. And also we'll become very familiar in particular with these 3 curves. Now, you may be asked to draw these series of cost curves. They're not particularly common, but you still may come across it in a question. I always like to start with drawing the average cost curve. So we know that comes down in sort of a U shape or a parabola shape. So we'll call this average cost. This is, which is the same thing as average total cost. Okay, we're going to bring the marginal cost through the through its minimum. Bring that up. And we know that fixed costs are going to come quite aggressively down and then approach but never reach the x-axis. And the reason for that is if your fixed costs were $100 and you were producing 1 unit, your average fixed cost would be 100, but then when you produce 2, it's going to very quickly fall to 50, and as you produce more and more units, that it falls much less aggressively. So average fixed costs will start up high, bring it down, and have it approach the x-axis, average fixed cost. Okay, and lastly, we need to add in the average variable cost. That's going to be below the average total cost because it's a combination of the fixed cost and the variable costs. It will be the difference in the heights of the graphs added together. So at the beginning, it will be a fair ways away from the average cost curve, and then it will start to approach it as the average fixed costs are spread over more and more units. So average variable cost, and the height is much smaller from the x-axis to the average fixed cost curve. So just a quick review to make sure that you remember what we've done. The shape of the average cost curve is basically a U or a parabola. Actually, this should be maybe perhaps a little bit more on an angle, not up and down on either side. Marginal cost and average cost cross at the minimum. Excuse me. At the minimum of average cost, so marginal cost is going to come up through the minimum. And just a reminder that marginal cost is the cost to produce 1 more unit of output. We haven't yet really looked at why average and marginal costs cross at the minimum of the average cost. So we've been looking at costs of production, but let's look at something that's more familiar, your marks. So we're going to think of the average in this case being the average of your marks at school, and we're going to look at ensuing tests or a marginal test, the next test that you write. You receive marks that were below your average. In this case, your average would, of course, fall. Now think what would happen if you started receiving marks for tests that were above your average. Your average would increase. So if we think instead of marks, and we think again of costs, and we look at the 2 curves, we have average costs, and we look at marginal costs. If we're dealing with over here, where marginal costs are below average cost, your average is going to fall. But if we're dealing over here, where marginal costs are above the average cost, your average is going to increase. If, of course, you are at where marginal costs equal average cost, it's going to have no effect. It won't bring down your average or bring it up. It will be in equilibrium. If a firm's costs were going to increase, this is very simple. We would have one cost curve here. So let's call this average cost 1. And then we would have another one here above it. So average cost 2. And of course, what would happen to profits if nothing else were to change? Profits would decrease. And if we were to look at a different scenario and we had better technology, then the average cost curve would in fact fall or be below the initial cost curve. So a standard marginal and average cost curve diagram should look like this, and you should be very familiar with this. So we've got the average cost here, and we've got marginal cost coming through the minimum. If we add in the average to fixed and average variable cost curves, it should look like this. So let's start off once again with doing the average cost curve. If we do the marginal cost, we're coming through the minimum. If we're adding the average fixed costs, we're coming down aggressively and then flattening it out. So average fixed cost. And lastly, average variable costs will lie under the average cost curve. Average variable cost. In the short run, I'd like to emphasize once again that at least one factor of production is fixed. In our simple case of the farm, it was land. We can only expand production by using more of the variable factors, and in that case it was labor. In theory, in the short run, the average costs of a firm should decrease as they produce more. Fixed costs are constant, so we know that they decrease in terms of being average fixed costs because they're spread out over more and more units. But in reality, we often see that the average costs may fall initially, but at a decreasing rate. A minimum will be reached, and average cost will then start to rise. So this leads us again to the law of diminishing returns. So the shape of the average cost curve revisited. So again, you want to know this very, very well. It's basically U-shaped, average cost. Average variable costs fall initially, and then the marginal product of labor eventually runs into diminishing returns, and so labor costs increase. If we look at the example of a series of short-run curves, so in the case of our paper chains, students were getting frustrated at one point as we added more and more workers. They wanted another stapler, they wanted more scissors, they wanted another desk or a factory floor, but in the short run that couldn't change. But if they were to move onto a second short-run cost curve, they could leave the first one and go into the second. So you can see here that we have short-run average total cost curve 1 and cost curve 2, 3, and 4. If we looked at, for a minute, hypothetically, if a firm was producing at, Q2, we could see that their costs would be here if they moved on to another short-run cost curve and, let's say, took on another pair of scissors and took on another stapler, but if they remained on the original production, they would be up here where their costs indeed would be higher. Now if we compare and contrast where we're operating with the first dot here to perhaps operating here we can see that it is indeed possible to have even lower average costs, and we will look at that in a minute when we look at the long run average costs towards the end of this presentation. In the long run, all inputs are variable. Why? Because you can buy more heavy machinery, you can buy more land, you can set up another factory. So everything is considered variable in the long run. So if we look at the long run average cost curve, we're going to see that it is much flatter than the short run one. The long-run cost curve is sometimes called an envelope curve because it envelops all of the short-run average cost curves. So let's first draw the long run. So we'll call this the long-run average cost curve. And then we're going to see that it can envelop a series of short-run curves. So I'll label just a few of these. That's one, then we've moved on to the second one. And so on. The long-run average cost curve is defined as a curve that shows the lowest possible average costs that can be attained by a firm for any level of output when all of the firm's inputs are variable. So remember, in the long run, there are no fixed costs. All of the inputs are variable because they can all be changed. We can also call this, it's also known as a planning curve or an envelope curve. It's known as a planning curve insofar that the firm can determine what level of output they desire and plan to know how to invest in heavy machinery, plant size, etc. In other words, in other capital. So when we left our first short-run average cost curve, if we wanted to take on more scissors, more staplers, and more plants, we would have to go on to the second short-run average cost curve, and we'd be moving along the long-run average cost curve and using the long run for planning purposes to figure out how much we want to invest in more capital. Notion of economies of scale and diseconomies of scale. This sometimes confuses students, but economies of scale really is nothing more than as you get bigger and as you produce more and more, your average costs decrease because you are getting certain advantages by being larger and producing more. Diseconomies of scale, in essence, are the opposite. As you get bigger, there's going to be disadvantages because your average costs are actually going to begin to rise. So diseconomies of scale can happen when, let's say, a firm just becomes so large that you have breakdown in communication, that management of all the different operations becomes problematic, and you actually start to see an increase in average costs as you produce more and more. So if we look at these different If we look at this in terms of our long-run average total cost curve, we can see at the beginning a firm will experience economies of scale as it produces more. At a certain point, those benefits start to plateau and you come across constant returns to scale. And then as you produce more and you become sort of large and burdensome and poor communication, you experience diseconomies of scale. So constant returns to scale. Let's look at actually in each case if a firm doubles all of its inputs. So for example, the workers and the raw materials and so on. If you double your inputs and output also doubles, then we're going to say you have constant returns to scale. If on the other hand you double your inputs and output more than doubles, you'll have increasing returns to scale. And lastly, if a firm doubles all the inputs and there results in less than double the outputs, then you have decreasing returns to scale.